My name is Cory Fulton, and I'm a software and industrials analyst here at Gabelli Funds. Today, I'm going to discuss recent comments made by Lennox International CEO Todd Bluedorn at an industry conference last week. I'm also going to discuss the impacts of these comments on the business. Today, we're going to discuss four main takeaways that we had from Mr. Bluedorn's comments. First, we'll discuss the impacts that tariffs have had on the business thus far. Second, revenue expectations for the second half of the year, as well as 2020. Third, the impacts of mix and pricing power on the HVAC industry as a whole. And then lastly, the topic of industry consolidation. First, with respect to tariffs. This year, tariffs will represent a gross headwind of $20 million, but a net headwind of only $10 million in 2019. The delta is from Lennox engaging suppliers in China to give back much of the impact from tariffs in order to keep Lennox from changing suppliers to Thailand or Malaysia. Mr. Bluedorn feels the tariffs forced Lennox and its competitors to accelerate changing suppliers from China to Southeast Asia, as China has become uncompetitive given the magnitude of wage increases the last 5 to 10 years. There has also been a realization that even ex-tariffs, the landed costs from Southeast Asia are lower than those from China, so even in a post-tariff environment, Lennox and its competitors will permanently remain with non-Chinese suppliers. Next, with respect to revenue expectations, in 2018, Lennox put forth a 6% revenue CAGR target through 2021, based partly on expectations that the company would capture 0.5 point to 1% of market share annually. However, due to a tornado at a prominent factory in 2018, Lennox's CEO now believes the company permanently lost 0.5 percentage point of market share. This loss equates to $90 million of lost revenue in the residential segment based on our 2019 revenue estimates of $3.7 billion in the segment. Mr. Bluedorn also stated that expressed feelings that the second half of the year would see muted volume growth. We had built this into our expectations, believing that the market share capture that the company expected were going to be tough. So Mr. Bluedorn's comments actually align with our estimates for the business for the next couple of years. Next, with respect to product mix and industry pricing power, Lennox's CEO believes that the company will get 3 points of price in 2019 in the company's residential HVAC segment. Additionally, the commodity headwinds of the last 2 years will turn into tailwinds in 2020. Mix, which has historically been driven by regulatory enforcement and efficiency gains for customers, will also continue to benefit revenues and profitability for the industry in the foreseeable future. We anticipated price contributing 2% and mix contributing 0.5% to 1% to revenues in 2019 and 2020, and these comments align with our most recent forecast for the business as well. Next, moving to industry consolidation, which has been a huge topic of discussion within the HVAC space in the last 5 years. Mr. Bluedorn mentioned that York, the residential segment of JCI, was subscale and would be a natural combination for Lennox. He also stated that Carrier would be a potential participant in industry consolidation once the company is officially spun from United Technologies. After meeting with management earlier this year, our personal belief here at Gabelli is that Carrier is Lennox's preferred combination target, but that the JCI combination would actually provide a better benefit to both businesses. And now, we conclude with our valuation on the company. First, the cap table. The company has 38.7 million shares outstanding, closed at a stock price of $235.66 for a market cap of $9.2 billion, net debt on the balance sheet of $1.4 billion for a total enterprise value of $10.6 billion. As you can see here, Lennox has very strong margins and returns on invested capital. On a sum of the parts basis using our PMV valuation process, we get to a share price of roughly $250, which is slightly above the market's price of $235. While we think the stock is slightly undervalued, the stock does not offer a large enough margin of safety to our estimation of the business is worth. However, we do highlight that this is what we do here at Gabelli Funds. We thoroughly research an industry and the companies within that industry and look for opportunities to purchase businesses trading at significant discounts to our estimate of private market value. So while Lennox may not be offering us an adequate margin of safety today, we will continue to monitor the business and the competitive landscape and wait until the market gives us an attractive price at which to acquire shares in a company that we believe to be of high quality with favorable market characteristics.